Thank you so much for joining me today.
Thank you for having me.
All right, let me say this. I mean, I understand there is some pride to the fact that the domestic, investors are taking over the market, but a 99% drop, I don't think that's, I said 99, a 90.99% drop isn't something, yes. I don't think it's something to be celebrated, but let me get your thoughts on that.
Yeah, I do quite get where you're coming from, but I think it's also very important we look at this particular discussion from two sides.
Okay.
So, I mean, the first thing is that, it's quite negative given the stage that we're in, like in the economy, we're in the recovery stage. There's a lot of FX reforms that's been implemented at this particular point in time. We're seeing improvements in terms of the macroeconomic indicators. Inflation seems to be trending downwards and all of those things.
It's just 1 month.
No, there was a pause that happened in March, but in February, inflation actually declined. So definitely, with the newer inflation figures we are seeing, definitely it somewhat appears that inflation is somewhat trending downwards, it's somewhat stabilizing. So it doesn't necessarily bode well for us, especially when we look at, the deployment in the FX markets. But I think it's also very important to look at that figure and the foreign participation that we saw in April 2025. So you'd see that, in terms of the participation, it was about 62%. And when you compare that to what we've seen historically, I think this has been the highest in the last 5 years. I think we reached the highest, the last time we reached this 60% levels was in October 2019. So it just goes to show, I think this figure just also told us about how global portfolio managers are viewing the investment climate in 2025. So we are currently seeing a situation where, these portfolio managers are having a very negative sentiment towards developed market assets. So they are thinking that, developed market assets are now appearing quite overvalued, and they are looking for a new investment destination that appears to be, that still has significant upside potential. And I think that's what emerging markets and frontier markets are able to offer, most of these investors. And we know that in the next 5 years, 70% of global GDP growth is expected to come from emerging and frontier markets like Nigeria. So, I mean, if GDP performance is expected to increase, that's supposed to have a positive performance on the stock markets in these emerging market economies. Also, another thing you'd want to look at is the fact that the US dollar has been depreciating for a while now this year, and that tends to be a positive catalyst for stock market. So aside from this volatility that we've seen, I think it's very important to look at how global portfolio managers are now viewing the investment climate. So should we see, a reduction in the volatility in the global space, I think we might start to see a return of foreign portfolio investors back into the Nigerian economy.
While I understand your explanation, I still want to understand what happened specifically in April. Look at the numbers in March, and we had block trades in March. But in April, that drastic reduction, I still want to clearly understand what happened in March and what happened in April.
Yes, certainly. So, I mean, in April, there was a lot of global concerns around the Trump tariff announcements. We saw that, the Trump administration put out a list, and on April 2nd, they called it a Liberation Day and said that, it was trying to find a level playing field with all its trading partners, and, it announced these humongous figures. I think for China, it's reached as high as 145% or 150% tariff. So that was significantly what led to, a global market rout. We saw about 2.5 trillion was wiped off from Wall Street. And in terms of the global stock market, we saw about $10 trillion being wiped off from the global stock market as well. So, that concern, stemmed, especially for a country like Nigeria, where, I mean, investors are still pricing in a repatriation risk, due to the events that happened in 2020, where a lot of investors were not able to access the foreign exchange market. So a lot of that made investors very cautious about the Nigerian economy. Another thing we also saw that led to that sharp drop was also the oil price slump. We had seen that Brent crude oil was expected to average around $70 to $75 per barrel in 2025. But what we had seen was that, Brent crude oil fell to as low, below $60 per barrel. I think it was trading around $58 per barrel at some point. And we know that, over 50% of our budget is dependent on the oil sector, so to say. So, I mean, foreign investors, if further weakened foreign investors' confidence in the Nigerian market. So we saw a lot of flights to safety. And this time, I'm not talking about the fixed income market, because we noticed that the fixed income market wasn't that hedged for investors, it was real assets like gold. So we saw that gold prices reached an all-time high of $3,500 per ounce. I mean, in terms of its return to investors this year, I think it's done averagely around 30% return. So we've seen that, gold was a hedge for investors, not even necessarily the fixed income market that we are used to in the past.
But to a very large extent, the whole gold thing is becoming balanced right now, especially looking at happenings. All right, so let's finish this on the offshore index declining by 62 basis points last week. And then we saw 4 trading sessions in the red and 1 in the green. Now, when you look at the month of May, what you would notice is that this is the first weekly decline. Talk to us about that. I mean, is it the CBN NPR, stuff?
No, I don't think it is per se. I mean, no, not necessarily. So you'd see that what investors were pricing into May was the Q1 earnings for a lot of corporates. So by the time you started to see, 2023-2024 period wasn't a very good period for cyclical sectors like the consumer goods sectors, the industrial goods sectors, and that was because, in terms of the FX environment, we saw significant devaluation of the FX environment as well as depreciation. And aside from that, inflationary pressures were significantly high. So that affected businesses, and we saw, a lot of companies declaring losses, at the end of the day. But we are seeing that, in Q1 2025, that started to reverse. Exactly. So companies that were declaring negative growth, now profitability now started to turn positive. I mean, for the likes of MTN, for instance, its revenue increased by over 40% year on year. But by the time you look at the bottom line, which was negative, because it had a lower base, it was negative, and this year is declaring a positive return. You see that the profit year on year increased by well over 100%. So that kind of spooked, the interest of investors in the stock market. And, apart from that as well, we also saw, domestic investors are now more interested in playing in the Nigerian equities market. You see that, the fixed income market, we started to see that yields trended downwards significantly in the first quarter. So, I mean, investors didn't really see, and we see inflation is still quite high. So when you're looking at, the positive real return, is still the stock market that can still give you that positive real return rather than the fixed income space compared to where inflation level is at now. So those factors, when we put all those factors into play, that was what led to the positivity that we saw in the stock markets in May 2025
All right, that's interesting. I wouldn't call it positive. You're to a very large extent.
No, I mean, the market was up 3 out of 4. 3.1%.
Okay.
Month to date, the market is up 3.1% already. True. You see that the consumer goods sector is already doing
Let's talk about the consumer goods. I mean, I would like us to have that slide on the consumer goods, year to date and month to date. It's taking the lead. And I think it's the confidence you're saying about the results and a lot of them turning profit. We're seeing what Nestle is doing. Presco, impressive.
Very impressive. And I think another thing that we've also seen from their end is that apart from the fact, in the last 2 years, what they've been using to majorly support themselves has been price increases across, some of their product lines. But what we're seeing that is happening, is playing out this year is that we're seeing volume recovery also happen. So that is also supporting higher revenue. We're also seeing that a lot of them are deploying a lot more cost management strategies to kind of, manage their margins, so to say. And another thing is that some of these corporates have done a lot of balance sheet restructuring. So I want to cite, Nigerian breweries, international breweries as an example. So last year, what we saw was that a lot of Nigerian breweries and international breweries did some rights issue into the market. And, by the time they raised, I think, Nigerian breweries did about 500 to 600 billion. I think international breweries did about 700 billion. So by the time they raised that significant significant figure from the market, they were able to use it to pay down on some of their outstanding liabilities as well as some of their trade payables. So we're seeing a situation where this year we kind of expect that in terms of finance costs are expected to be lower, and their exposure to USD are somewhat reduced. And now we're seeing a stability in the FX environment.
I think I'd like to have you some of the time so we can continue this conversation.
We do expect to see cost to sales ratio lower. So I think definitely these factors are expected to,
I think you're like me, but I'll stop you here. Oreoluwa Odetunde, Head Research, Anchoria Asset Management. Thank you for coming on the show. We're going to have this conversation some other time. Definitely.